Good evening. Today I want to talk about the ARC blockchain. Circle just spent years building something that either will revolutionize stablecoin payments or become the most centralized blockchain in crypto history. While everyone is celebrating ARC's launch, BlackRock, Visa, Goldman Sachs on board. Nobody's asking the uncomfortable questions like, why does a blockchain need permission to validate transactions? How is Circle making billions by routing USDC through ARC instead of Ethereum? And what happens when those trusted validators decide the rules? Today, we're going to go where mainstream crypto media won't. Hopefully, we can uncover the real story behind the ARC blockchain. Well, let's start with something that the press releases aren't telling you. Circle's stock has dropped 75% from its IPO highs, despite being valued at $18 billion. USDC supply has been flat since October of 2025. No growth in stablecoin adoption means no revenue growth. Adding falling interest rates into the mix, and Circle has got a serious problem. But here's the kicker. Circle has a revenue sharing agreement with Coinbase. Every dollar of USDC held on its platform, like Coinbase or Base, means Circle pays Coinbase a significant cut of interest earnings. We're talking 200 million per year just for the 4.3 billion USDC on Base. So, what's the solution? Build your own blockchain where you can control the economics. Enter ARC. It's a layer one where Circle keeps 100% of the revenue from USDC held on chain. No sharing with Coinbase, no splitting profits with Ethereum validators, pure margin expansion. Circle frames this as a purpose built infrastructure for stablecoin finance, and that's true. But it's also a vertical integration play to capture that value that's currently leaking to other ecosystems. That's going to change everything about what we know and how we evaluate ARC. Let's look at ARC's technical stack. ARC uses two cutting edge components: Malachite, a Rust rewrite of the Tendermint consensus, and then there's Reth, a paradigm's modular Ethereum client. This combination delivers impressive specs, but with significant trade-offs. Now, let's talk a little bit deeper about the tech again, okay? Arc runs on Malachite. It's a high-performance implementation of Tendermint Byzantine fault-tolerant protocol. And if you're familiar with Cosmos, you've seen Tendermint in action, but Malachite is a completely different Rust rewrite altogether by Informal Systems, now owned by Circle after their recent acquisition. Now, here's why all that matters. Tendermint gives you deterministic finality in under 1 second, unlike Ethereum, where you have to wait multiple confirmations. Our confirmations are either pending or absolutely final. No reorgs, no uncertainty. That's great. And that's perfect for institutional payments. This is huge. Now, at the execution layer, using Reth, this is a Rust-based Ethereum client. This means Arc is an EVM compatible blockchain. Developers can use Solidity, Hardhat, all the tools they know. Arc isn't reinventing smart contracts. It's just optimizing the environment that they run in. Let's look at the performance benchmarks. 3,000 TPS with 20 validators. Smaller validator set, and it can hit 10,000 TPS. For context, Ethereum mainnet does about 15 TPS. Solana does 3,000 to maybe 4,000 transactions per second. So Arc is competitive. But here's what no one's mentioning. These numbers assume permission validators in controlled environments. Now, if you add network latency, geographic distribution, real world chaos, those numbers could potentially drop. So Circle's betting on institutional infrastructure making up that difference. All right, let's talk about USDC as gas. Arc's killer feature. This is where Arc does something very radical. Instead of buying ETH or SOL to pay for transaction fees, they use USDC. That's it. Your Treasury Department doesn't need to hold volatile crypto. Your CFO isn't sweating over ETH price swings affecting operational costs. Fees are denominated in actual dollars. ARC implements this through a fee smoothing mechanism. Instead of a block by block fee spikes like Ethereum, ARC uses an exponentially weighted moving average. Translation: gas prices change gradually, predictably. Enterprises can budget transactions costs just like any other business expense. Now that sounds amazing, right? But here's the catch. Using USDC as gas means that Circle controls the monetary policy of the entire chain. They can adjust the fee mechanisms, the treasury management, and the economic parameters. If USDC ever depegs, even temporarily, the entire network fee market can break. You're not just trusting the blockchain, you're trusting Circle's ability to maintain USDC's peg forever. Compare this to Ethereum. If Ethereum drops 50%, gas gets a hell of a lot cheaper in dollar terms, but the network still functions. On Arc, if USDC breaks, everything can stop. That is a very powerful systemic risk on a whole new level. So we're going to see how this unfolds. Arc uses something called proof of authority with permissions validators. This is the most controversial design decision and the one Circle's downplays in marketing. Here's where things get a little bit uncomfortable. Arc uses proof of authority with a permission validator set. That means you can't just stake tokens and become a validator like Ethereum. Validators are selected institutions like banks, financial firms, enterprises that meet Circle's criteria. Circle's justification is that these validators' reputation, compliance requirements, and operational guarantees. They're geographically distributed, they're regulated entities, and if a validator misbehaves, there's a real world legal entity to hold accountable. In theory, this sounds great for institutional adoption, but in practice, you're trusting the same financial institutions that crypto was supposed to be disrupting. Now, let's be specific about what that means. Circle decides who is going to validate those transactions. Validators can collude, They're also known entities who likely already do business together. Governments can pressure certain specific validators to censor transactions. There's no economic penalty for misbehavior, only compliance obligations. Circle promises an eventual transition to permission proof of stake. But when, under what conditions, with what governance, these questions remain unanswered. ARC promises opt-in privacy through confidential transactions. Users can shield balances and transaction amounts while maintaining the ability to selectively disclose information via keys. This implementation trusted execution environments, basically secure enclaves in Intel SGX or AMD SEV chips. These are the same technologies that Apple uses for Face ID or banks use for payment processing. TEE privacy means trusting hardware manufacturers. You're betting that Intel or AMD didn't build backdoors into their chips. You're trusting that no side channel attacks exist. You're assuming governments can't compel hardware vendors to compromise their enclaves. Contrast this with zero knowledge proofs on protocols like Zcash or Aztec. Zero knowledge proofs are mathematically guaranteed, no hardware dependencies. TEEs are trust but verify models where verification is limited. Circle's roadmap mentions future cryptographic backends as alternative to TEs. But when? And if those alternatives exist, why launch with TEs now? It feels like they're trying to ship out a fast solution rather than the most trusted one. Art still faces some serious competition, and it's all happening right now. First up, we've got Plasma, backed by Tether and Bitfinex. Plasma uses USDT as gas, launched mainnet earlier than ARC, and already they have live applications. They're further along in development and have Tether's 140 billion stablecoin supply at its advantage. Then there's Tempo. This was built by Stripe. Remember, Stripe processes more payment volume than most countries' GDPs. But they're not building a blockchain for fun. They're building infrastructure to capture the next generation of global payments. And then let's not forget about Base. Coinbase's layer 2 that already has a massive USDC adoption, low fees, and a thriving DeFi ecosystem. Base isn't stablecoin native, but it doesn't need to be when it's got the network effects and distribution through Coinbase. So here's the reality. This isn't about technical superiority, it's about distribution. Plasma has Tether's reach. Tempo has Stripe's merchant network. Base has Coinbase's 100 plus million users. ARC has Circle's institutional partnerships. The winner won't be determined by a consensus algorithm or TPS benchmarks. It'll be determined by who controls the most valuable financial relationships. And in that game, ARC is playing catch up. Circle recently acquired the team behind Axelar's network to accelerate its cross-chain interoperability. This isn't just an acquisition. It's a strategic infrastructure for making ARC the hub of stablecoin liquidity. In December of 2025, Circle made a strategic acquisition that flew under most people's radar. They acquired Interop Labs. It's the core development team behind Axelar's network, one of the leading cross-chain interoperability protocols. This team built technology that enables secure asset transfers between different blockchains. Why does this matter for ARC? Circle's cross-chain transfer protocol is critical infrastructure for moving USDC between different blockchains. But CCTP only works for Circle's stablecoin. By acquiring Axelar's tech and their team, Circle can build a general purpose cross-chain bridge that makes ARC a liquidity hub for all stablecoins, not just USDC. Think about the end game. ARC becomes the settlement layer where different blockchains meet. USDC, EuroC, USDT, PYUSD, all flowing through ARC for instant dollar denominated swaps. Circle captures transaction fees on every cross stablecoin trade. This is Visa level thinking. Circle didn't just build any blockchain, they're building the financial plumbing for the entire stablecoin economy. And if they pull it off, ARC becomes infrastructure that's too important to ignore, even for competitors like Tether. ARC currently has no native token. Gas is paid in USDC. Validators are a permissioned institution. There's no public token to speculate on, farm, or airdrop. A crypto Twitter is not happy about it. Circle has been coy, saying they're considering a native token or evaluating options. Industry insiders believe a token is inevitable, but timing must be strategic. Here's why. Look at Plasma. Tether's stablecoin chain launched with aggressive token incentives and it saw immediate liquidity bootstrapping. TVL surged, developers migrated, users showed up for the airdrop and stayed for the ecosystem. ARC could follow the same playbook, launch without a token, build institutional partnerships, prove the tech works, then drop a governance token with retroactive rewards for early adopters. I think this approach minimizes regulatory risk while maximizing FOMO. But there is a catch. Tokenomics for a permission chains are weird. If validators are selected institutions, what does a governance token actually govern? Fee parameters? Validator selection criteria? The token risk being governance theater rather than meaningful decentralization. So, my prediction, Circle launches a token by, let's say, mid 2026, structured to reward enterprise users rather than DeFi degens. Think of it like this: loyalty points for transaction volume, not yield farming. It'll feel more like American Express membership rewards rather than a DeFi summer. ARC's testnet launched with the backing of BlackRock, Visa, Goldman Sachs, and AWS. These aren't altruistic partnerships. TradFi partners see ARC as critical infrastructure for tokenized finance. ARC's partnership tell us a little bit about their strategy. Now, BlackRock, the world's largest asset manager with 10 trillion under management, is testing ARC, not Ethereum, not Solana, but ARC. Visa is also involved. The company that processed more transactions per day than Bitcoin's entire history is exploring ARC for settlement. Now, we've also got Goldman Sachs, they're a validator. One of Wall Street's most prestigious firms is directly participating in ARC's consensus mechanism. Now, why is that? Because ARC speaks their language. Predictable dollar denominated fees, known validators with compliance teams, deterministic settlement, no anonymity, seeking DeFi protocols they can't explain to regulators. These institutions aren't interested in decentralization for decentralization's sake. They want blockchain technology that fits existing regulatory frameworks and offers cost savings over legacy payment rails. ARC delivers that. On the flip side, if BlackRock, Visa, or Goldman controls ARC's future direction, whose interest does the network serve? The public good or private profit? This question isn't theoretical. It's fundamental to whether ARC becomes a genuine infrastructure or another corporate platform, basically. So, despite extensive documentation, critical questions about ARC's long term design still remain unanswered. These aren't minor details. There are fundamental uncertainties about how the network will evolve. Just a couple questions we may have. So, what about the validator admission criteria? How does an institution become an ARC validator? What objective standards do exist? Can Circle unilaterally reject application? There's no public validator application process that's documented currently that we can review. Um, what's the long-term decentralization path? Circle promises eventual transition to permission proof of stake, but when? Under what conditions? What prevents them from maintaining proof of authority indefinitely? Because institutional partners prefer that current model. Just a few questions. There are legitimate design challenges that every serious developer should understand before committing resources to ARC. And one more thing. So, should you build on ARC? What does it depend on? Cross-border B2B payments? If you're moving millions between companies, ARC's deterministic finality and dollar-denominated fees are a killer feature. Settlement certainty matters more than decentralization for most enterprises. Tokenized securities and real-world assets, these are regulated financial instruments that need compliant infrastructure. ARC's permissioned validators and opt-in privacy align with securities laws, and that's where ARC shines. If users are asset managers or hedge funds or treasury departments, ARC stability and known validators reduce operational risk. They can sell to their compliance teams. When we think about permission DeFi protocols, if your value proposition is censorship resistance or anyone can participate in the design, ARC's proof of authority model kind of undermines your core thesis. When you think about consumer crypto apps, unless your app specifically needs dollar stable fees, Ethereum layer 2s or Solana offer better ecosystems, tooling, and user bases. ARC won't help you go viral with retail users. So, if your application might face some regulatory pressure, ARC's permission validators are liability, not protection. They can and will censor transactions if compelled. The pattern is clear. ARC excels at enterprise use cases where compliance, stability, and predictability trump decentralization. If those aren't your priorities, ARC offers little advantage over existing chains. I hope you enjoyed this session. I'll speak with you later. Have a good evening.